Ever wondered why price bounces perfectly from some levels but slices straight through others? It's not magic, it's supply and demand. And once you learn to spot these zones, you'll start trading with the same edge institutions use. Most traders chase indicators: RSI, MACD, moving averages. The problem? Indicators lag. By the time you get a signal, the smart money has already entered or exited. But supply and demand zones? They're the footprints of big players. They show you where the orders are stacked, waiting to push price up or down. Once you can read them, you'll stop reacting late and start anticipating moves in advance. Here's the concept in simple terms. Demand zone, an area on the chart where buyers stepped in aggressively, pushing price higher. When price comes back, those buyers, or new ones, are likely to step in again. Supply zone, the opposite, a region where sellers dumped heavy orders, driving price down. When price returns, those sellers, or new ones, often defend it again. Think of these zones like magnets. Price gets attracted to them, reacts, and often reverses. That's why professionals don't just look at lines, they look at zones. Spotting supply and demand zones isn't complicated. Look for a strong, impulsive move away from a price area. Mark the base of that move, the small consolidation or sideways candles right before price exploded. That base is your zone. Next time price revisits it, watch for reactions. Pro tip: the fresher the zone, the stronger the reaction. The more times it's tested, the weaker it becomes. Here's how you can trade with zones. At a demand zone, wait for price to retest, look for confirmation, like rejection wicks or bullish candles, and then go long with a stop just below the zone. At a supply zone, do the opposite. Short when price retests with rejection signals, and stop just above the zone. This way, you're trading where institutions are active, not where retail indicators lag behind. But here's the thing. None of this works if you're trading with delayed data or unreliable execution. Institutional traders don't just have better strategies. They have better data, faster execution, and regulated brokers they can trust. You deserve the same edge. That's why our team spent months researching and testing brokers to find the ones that give you institutional-grade speed and reliability. We've done all the homework for you, checked regulations, tested execution speeds, and verified spreads. Visit BrokerCheck and see our top-rated regulated brokers. Don't let bad data or slow execution kill your supply and demand trades. Now let's get to the topic and learn from a real example. Let's say EUR USD drops sharply from 1.0950 after consolidating for a few hours. That consolidation before the drop is your supply zone. When price comes back to 1.0950, it stalls again because big sellers are defending. If you'd marked that zone, you'd be ready to short while others are confused. Here's your challenge. Pick one chart today, mark the most obvious recent supply and demand zones, and watch how price reacts when it returns. The patterns will surprise you. Hit like and drop a comment telling me, do you find supply zones or demand zones easier to trade?